Hello and welcome to Smartkarma's corporate webinar. I'm Anisha Kundu and I lead the corporate solutions team for Smartkarma. This week we have with us Japfa's CFO, Kevin Monteiro. We will start the webinar with Kevin walking us through a company presentation, after which he will engage in a fireside chat with Jason JAP, a Smartkarma Insight Provider. We will be taking a live Q&A, so I request the audience to please send through your questions in the Q&A button at the bottom of your screen. And during the webinar, I will also share some links on how you can connect with Japfa and also Jason. So please keep a lookout for messages in the chat box. And now I hand it over to Kevin to take the webinar forward.
Thank you, Anisha. Okay, let me try and share my screen. Welcome, everybody. So I'll give you a quick introduction to Japfa for those of you that don't know us. So let me start with what we do. So basically, we're an industrialized agri-food company. We feed emerging Asia with essential proteins. We operate a bunch of feed mills, modern farms, processing plants in 5 countries, which is Indonesia, Vietnam, Myanmar, India, and China. We are headquartered in and listed in Singapore, and we employ about 40,000 people across the group. So essentially, we run our business as 3 business segments, and we're vertically integrated business model. So we do upstream, which is we make animal feed and we breed babies basically in our breeding farms. And then we've got midstream, which is fattening or milking, and downstream, which is the production of consumer food products. Now we run our business in 3 main segments, being animal protein, PT Japfa Tbk, which is our operations in Indonesia. And there we do 3 proteins, which is chicken, beef, and aquaculture. Then our second segment is animal protein other, which is poultry business in Vietnam, Myanmar, and India, as well as the swine business in Vietnam. And our third segment is dairy, which is basically dairy farming in China, along with some beef production. So we take an industrialized approach to farming and food production. Now, what does that mean? That means we have certain core competencies. So when we operate on scale. So we enjoy economies of scale, and this is particularly important in our feed business. We also use technology. So in our case, it's leading genetic companies JV'd or work with us very closely so that we start with good breeds and good genetics. Then we complement that with advanced feed technology and best farm management practices. Now, what is important in livestock farming is to make sure your animals, whether it's a breeding farm or fattening farm, they are essentially well looked after. And that's not only in feeding and in farm management, it's also in their health status. So we engage and employ the best-in-class biosecurity with stringent operating procedures. And I think one of the standouts for us is we actually have an in-house vaccine production company where we can do our own in-house research and production of vaccines for any particular viruses or bacteria that would affect our animals. Now, the 4th core competency that we like to talk about is what we call standardization and replication. So really, we started with the poultry business in Indonesia some 50 years ago. And from a feed business, we expanded to breeding. Then we went down to commercial farming, and then finally to the downstream, where we produce chicken nuggets, etc., in Indonesia. Now, that was chicken. And from that platform, we expanded to aquaculture and then to beef in Indonesia. And from that poultry platform in Indonesia, we expanded to different countries with the poultry base. And from our beef experience in Indonesia, we started dairy in Indonesia and we expanded into China. And what all that means is we established ourselves 50 years ago. We are now in 5 countries with 5 protein businesses. Our market cap is over $1 billion US, and our 2020 revenue was almost $4 billion US. So what is our growth prospects? I mean, what is our business? Where does it go? I think if you look at the 5 countries we operate in, it's really in what we term as Japfa Emerging Asia. And if you look at some of this GDP per capita and population sizes, I think what we're trying to say here is the countries that we operate in are a sweet spot, both in terms of their past GDP CAGR growth, as well as the size of the circle represents the population. So actually, they are a low GDP per capita, and in the low GDP per capita market, there is a potential for a consumption growth in basic staples like proteins, and that's on the left-hand side. So if you look on the bottom right graph, it's also an interesting graph in that if you look at Indonesia, the consumption of chicken per person per year is about 8 kgs. And a comparable would be Malaysia, which is same religious demographics. And in Malaysia, they consume well over 40 kgs per person per year. So the reason that Indonesians consume so little is because the GDP per capita means that they cannot afford to eat chicken as much as they would like to. So that is our potential for growth. By operating in Indonesia, Vietnam, we are actually looking for that intrinsic growth in GDP per capita, which will drive growth in protein consumption, which essentially will drive our business growth as well. Now, when you look at where we sit today in terms of market position, so we are number 2 in Indonesia in terms of both feed and day-old chick production, and a strong number 2, I would say, from the pie graphs at the bottom. We also have some strong positions in Vietnam, Myanmar. When we talk about China, I'll come to that. So in China, we have the best yields in China in terms of a dairy farming operation. And this is a Rabobank graph that compares yields, which is the amount of milk produced per cow per day. It's a bit of a dated graph going back to 2018. And because there are other listed companies on the Hong Kong Stock Exchange that do the same business as us, which is dairy farming, they also release their yields. And that allows us to actually put out a comparative on how well we basically look after our cows and how much more they can deliver. So if you look at Japfa, Australia, China on the left-hand side, in 2018, we were delivering like 34 kgs per cow per day for our total herd. And if you look at China Modern Dairy, which is two bar graphs down, when they deliver less than 30, it means for the same cost of looking after that cow, I'm getting more milk. And that's what yield works out at. That means I'm going to have a better bottom line because I'm able to produce more milk for the probably a similar cost to another industrialized producer like China Modern Dairy. Now, if you look at the red line, it's actually the China average. So that includes not only the industrialized dairy farmers, but the non-industrialized backyard farmers as well. And they were producing something like 20 kgs per cow per day. And when you can actually produce much more, it shows you the efficiency in an industrialized model in terms of delivering a higher yield. And in other words, for the same cost, you're actually delivering much more output and feeding a lot more people with protein. So I think this, in dairy, this yield information does reflect that we are good farmers. We know what we do. We are able to actually look after animals well so that a happy animal actually is very productive, whether it's producing milk or it's actually putting on weight. in terms of animal protein business. So I think our expertise is actually being able to operate our farming operations with a great efficiency. And the second part of our expertise is being able to operate in emerging Asia, which is very different from operating in, say, a more established country like the US. So where if you were operating a dairy farm and your tractor breaks down, you just need to call a tractor company and he's there to fix it in 2 days. You know, you wanted some alfalfa, it just appears. But when you're operating in Asia, and especially in remote parts of emerging Asia, whether it's China or Indonesia, you need to have your own tractor repair group because nobody else is going to turn up the next day to fix it for you. And you need to actually encourage farmers around you to grow the fodder that will become the feed for your cattle because nobody's going to deliver it to your door. So I think that's our strength. It's the ability to industrialize in emerging Asia, to take opportunity of the growth that emerging Asia presents in terms of their growth in GDP per capita going forward. Now, I think one feature of our business is the cyclicality of an agri-food business. And a lot of people actually look at our profitability and to some extent our revenue, and they see the cyclicality and the seasonality. And this is typical of agri-food, where in parts of my business, I'm dependent on the market demand and supply dynamics in each country. And that can change with a lot of external factors that go beyond the company's direct control. So what can the company do? So what the company does is to make sure that we've employed an industrialized approach to farming so that the company can be one of the most efficient and lowest cost producers in that market. Now, I want to stress that we actually produce locally for the local market. So Japfa does not extensively export things. So it really produces chicken in Myanmar for Myanmarese, pork in Vietnam for Vietnamese, and milk in China for Chinese in China. So what does that mean? So if you strive to be one of the most efficient and lowest cost producers in that country, whatever happens, whatever macro factors that affect purchasing power, government policies, whatever that affects that country, if you're one of the most efficient, lowest cost, you will survive. And why? Because we produce a very staple, basic food for the people of that country. We're not making chicken into a funky food, with a particular taste. We just produce the staple meat most of the time. And that's the essence of our business. So we've gone through certain cycles, and what we put out on this slide is actually to show that we go through these major downturns. In 2014 and 2015, Indonesia went through an extraordinary down cycle that lasted between September 2014 to June 2015. It impacted our business in Indonesia quite dramatically. But here, you actually, when you look at the EBITDA for the total consolidated group, you can see the EBITDA was about 265 to 300 million in those years. Now, in 2017, we went through an extraordinary down cycle in Vietnam for swine, where the company in its swine operations in Vietnam lost money for 5 consecutive quarters from the whole of 2017 into first Q 2018. And that was a dramatic down cycle as well. We still generated an EBITDA of about 300 million. So we are cognizant that our business actually has a cyclicality element. But what we are saying is because of our diversification strategy, where we've got 5 different proteins in 5 different countries, that is effectively to cushion some of that cyclicality that would happen in any one market or affect any one protein. So I think that's broadly my 10 minutes to give you a broad outline of what we do, hopefully, and also some elements of how you should look at our business and in terms of growth and in terms of the major impacts on the business. So I will now hand over to Anisha to open up for questions, I guess.
Actually, Jason, I'll hand it over to you to.
Right. Thanks, Kevin.
Sorry, Jason.
Thanks, Kevin, for the presentation. For the attendees on the webinar, please keep your questions flowing. I'll try to incorporate as many of them as time permits. And so, Kevin, just to kick things off and to some extent be the devil's advocate. When we talk about Japfa, we are familiar with 5 proteins, 5 countries, and vertical integration. So why is there such a high conviction in this business strategy? And perhaps you could explain this in terms of how Japfa managed to weather the pandemic disruptions in 2020 and even this year.
Okay, sure. So I think because of our diversification strategy, essentially Japfa essentially is, sorry, there's a screen issue here that I'm trying to get out of. Give me 2 minutes. Let me get that. You mean I'm still on the, sorry about that. I don't know what you guys are seeing, but okay, so let me just talk. Essentially in COVID, COVID affects our business, we feel, in 3 ways, right? So that's either operations, supply, or demand. In terms of operations, in terms of supply, it's affected our business in a very minor way, essentially because we produce a staple protein, Jason. So most governments make sure that our business is not disrupted in any way because they want food to still get delivered to their people. So what is affected is demand. And demand can be affected quite dramatically when you actually have stringent lockdown measures in different countries, right? So we were fortunate in that the demand impact happened in different markets at different times. So for most of the time, we were quite cushioned in that COVID didn't affect all of our 5 countries at the same time. But in the last quarter in particular, COVID did impact 2 of our major markets, being Vietnam and Indonesia. So in Vietnam was probably their first wave, their first big impact of COVID. And for Indonesia, it was the second wave that impacted Indonesia in a big way. And that really did hit our 3rd quarter numbers recently. Yep. But, you know, I would say that all in all, it shouldn't be a long-lasting impact because people have got to work. I mean, when we talk about emerging Asia, we're talking about Indonesians where there's a whole bunch of day workers and contract workers, and if they are not allowed to actually work, they don't have an ability to earn income and feed their families. So hence the lockdowns tend to be quite short. And I think in Indonesia, the worst is over as far as we can see, if something else doesn't happen. For Vietnam, you know, the lockdowns have been very severe in the 3rd quarter of this year, but hopefully that will ease off, but it's a bit early to tell on how that is going to go. But overall, I would say COVID has not disrupted us in any big way. I think up to the 2nd quarter of this year, we were showing record profits since we listed in 2014 in Singapore as a group. So I think we've managed to weather most of the storm. And I think in the long run, we'll continue to do so because we produce a stable protein, basically.
All right. Thanks, Kevin. There's several questions on the dairy business, and it's probably a sort of a hot button topic because of the several transactions we've seen in the past 12 to 18 months. And we might have to split the discussion between Dairy China and Dairy C. So maybe just to get Dairy C, the smaller part of the business, out of the way, could you tell us what were the strategic considerations for the disposal of the Greenfields stake in Southeast Asia?
Sure. So we started that business some 20 odd years ago. And actually it was, the driver behind that business is my chairman, Handoyo Santosa, that believe that if you bring the milk business closer to a potential market being the Indonesians, because if you want to deliver fresh milk from Australia, it's actually the cost of delivering liquid, which is very expensive, right? I mean, we're talking about high-end pasteurized fresh milk, not powdered milk. And his vision was to start a dairy farm in Indonesia. And we started the single largest industrialized dairy farm in Southeast Asia at that time of 6,500 heads. And it was basically a crazy project because dairy cows like cold weather, they hate warm weather. And I think he persevered because that business obviously lost money for many, many years before it got off the ground. So it took a while, but in the end, Greenfields has managed to secure some 50%, that's 50, of market share in Indonesia for the fresh pasteurized milk. And they introduced stirred yogurt maybe 2-3 years ago, and like 6 to 9 months, Greenfields became the #1 stirred yogurt brand. So it had a strong branding, and it was a branding that was developed over the last 20 odd years in, how would I put it, in a very slow and concerted manner. Now, I believe that why we sold Greenfield was evolution of certain events. So really, it started with us looking for a strategic partner in China to take a share in China, and that was when Meiji came in. And Meiji was not interested in dairy Southeast Asia because it wanted to focus on China and wanted to focus on growing its business in China, and was looking for a strategic partner that could supply raw milk to support their growth aspirations. So because of that, we actually split the dairy business clearly into dairy Southeast Asia and dairy China. And once we split it and we did the Meiji transaction and announced it, we got a whole bunch of people that basically said, I was always interested in your dairy Southeast Asia and not dairy China, because I know nothing about the China business. Right. And we got so many inquiries, and that we ran a process. And at the end of the process, we felt that we are getting a very fair offer from the buyer of our Greenfields business. And it was also a PE fund that can probably take that business to the next stage. What do I mean? I think we're very good farmers. I think we know that really well. But in terms of downstream, it takes us a long time to build a brand. And in terms of the scope of our business also, if you look at just chicken in Indonesia, 85% of the chicken we sell today in Indonesia is through the wet market distribution system. In other words, we sell the chicken live, Jason, you know. Yeah. So only a small percentage of the chicken we produce actually works out as consumer foods or branded consumer foods or chicken nuggets, you know. So our experience in that downstreaming side is small compared to the experience in the farming side, which is much bigger in producing live animals for sale, whether it's chicken, whether it's pork in Vietnam. So hence, I think we don't have that, how would I say, that super expertise in the downstreaming. And I think there is opportunity in Indonesia to expand the downstreaming side of the business, to take the consumer part of the business and expand it quickly. And I think a PE firm has the abilities and the breadth of experience and the connections globally to hopefully take our Greenfields business to the next stage. And of course, we retain a 20% share. So we're very pleased with being able to participate, hopefully, in what's left as an upside to that business going forward. Yeah. So that was the Greenfields transaction, Jason.
All right, thanks, Kevin. So shifting the attention now to China dairy, which is sort of the bigger part of the business. So Japfa has been trying to be a leader in the raw milk supply business in China. And we've seen Japfa striking out partnerships with Meiji, for example, which has agreed a 5-year offtake arrangement for raw milk supply. And just to highlight the revenue numbers for China Dairy, it's actually a 12% revenue contribution, but a 57% core profit contribution. So in a sense, China Dairy is punching above its weight. So looking at the transactions in the past 12 to 18 months, it's sort of gone in two directions. One, it's you guys have been acquiring Shandong farms, for example. At the same time, you're bringing in minority shareholders, such as Meiji and New Hope. So could you help the audience understand and reconcile the strategic considerations behind these transactions?
Okay, Jason, thanks for that. I mean, that's a very good question, actually, because it does look as if it's conflicting strategic moves, right? But I think it actually, hopefully I can explain how it does forge together logically. So by introducing strategic partners, I mean, these strategic partners, which is Meiji, New Hope, Genki Forest, and Honest Dairy, they are all our current customers that buy our raw milk in China. So they know the product that we sell, they know our business. Now, when you look at the China landscape, you can see that the two major dairy downstream producers, which is Mengniu and Yili, they have been consolidating the dairy farms under China Modern Dairy and the newly listed Yuran, and which are all majority owned by respectively Yili and Mengniu. So the independent producers, including the likes of New Hope, are just securing strategic partnerships with us to secure their supply for milk, for their own production of downstream dairy products. Now, that works in very well with us because they are aligned in growing their business going forward. And that aligns with our growth as well, our growth aspirations for producing raw milk that we can sell to them. So we are, as you say, forging long-term relationships with our partner customers, I guess. Yeah. And I think also by introducing New Hope and the like, they are Chinese dairy companies. So to some extent, hopefully that will also alter the view of our business as a foreign-owned business in China. So I think all that helps strengthen and solidify our long-term growth aspirations. So hopefully people can see that we are there for the long run. We want to grow. We are aligning ourselves with quite strong dairy companies that have very good aspirations to grow. Now, to complement that and exactly what you said, you know, we actually went out and acquired 2 new farms from Monteiro that was up for sale, and that is to drive the growth process of our production. So on the one side, we are selling down the equity participation, but on the other side, we are trying to grow the business at the same time.
Yeah. All right. Thanks, Kevin. There's a few very specific questions on the dairy business. I'm not sure if you're in the position to address them. Maybe
I'll try.
Give a general comment. So firstly, one is saying, do you have plans to list the China dairy business in Hong Kong? And 2 is, would you expand the dairy business to other countries apart from China?
Okay, I think the CEO has been very clear in that we try to build parts of our business so that they can operate independently. And that's how we actually run our business. The segments that I talked about earlier, about our 3 major segments, as well as the 5 countries, we tend to operate that quite independently. So it's Japfa is not big enough to be an MNC. So we don't have a central treasury. There's no you know, centralized operation. But basically, each country operates as independently as possible, including financing itself and financing its growth, right? So what we try to do is build those businesses into billion-dollar businesses. I mean, we've done that in Indonesia in poultry. I mean, Indonesian business well over 2 billion US. I think the dairy business is, as you know, from the two transactions being Meiji and all these transactions along with the greenfields, the dairy business was valued at $1.3 billion if you just extrapolate from the pricings. So you can say the dairy business today is a billion-dollar business by itself. And for them to actually grow like how we grew PT Japfa Tbk in Indonesia, which is listed, it is very independent of Japfa Limited. They do their own bonds, their fundraisings, etc., and they actually fund their growth independently as well. So I think dairy is getting into that position, that it can stand alone and it's got the size. So I think the next stages are always on the cards, and I that's all I can say. That each thing has the ability to actually try and grow and develop itself accordingly. So on the second point was, sorry, I forgot the second point, Jason.
The IPO in Hong Kong.
Yeah, so IPO is always something that has been around as the next stage of where it goes, but that's basically all we can say. That's never off the card, so it's never on the sorry, the second part of the question was
expanding beyond China, but I think that's been addressed.
Expanding beyond China. To some extent, the strategy of actually selling greenfields was so that our dairy team can focus on the growth that we are thinking of in China.
Yep.
So it's a pullback from Indonesia, right? So I think the growth is so strong in China and the opportunities are there in China because there's a gap between demand and supply. So there's a shortage of supply of raw milk. So I think the dairy team will focus on China for the time being. As far as I can say, and then those opportunities of course sit in the other regions. So maybe one day when we have enough human resources and people to actually explore new markets.
One quick question, maybe you can just give a quick comment. So we have a question here asking if plant-based protein will pose a threat to Japfa's protein business. Maybe just a quick comment.
Okay, so essentially, of course, that's something we need to look at, but it's more a long-term view that we need to take there. I think what we are more concerned with is the malnutrition that occurs in many of the countries we operate in. So there's a high rate of stunting for children in Indonesia because they're not getting enough of a balanced diet, including protein. So our role is actually to try and make protein as cheap as possible, to get it out to many people as possible. And I think that will dominate our space for the time being. But obviously, in more mature markets and I guess first world issues, and to some extent, but to a much lesser extent, because we are talking mainly of chicken, climate issues, I think we need to look at some of those plant-based alternatives in the near future.
So just taking off on that angle on ESG. So as an agri producer, you guys are front and center of the related concerns, whether it's pertaining to food sustainability, supply chain resilience, and things like that. So could you share with us high level, perhaps your journey or challenges faced, and perhaps your general approach to approaching ESG?
Sure. So I think I'll just continue with what I just said. That basically our responsibility is providing staple protein foods to about 20 to 25% of the population in the countries we operate in. So that's quite a big responsibility. And if we try to be efficient and cost effective, hopefully we can do that in a manner that is beneficial to a higher rate of consumption of staple proteins in the population. And that fits very nicely with the UN Sustainable Development Goals number 2, which is a zero hunger goal. And, you know, I think when we look at establishing our sustainability pillars for our sustainability initiative, we looked at that goal as being probably the dominant goal that we're going to focus on in the near future, right? So we tend to take this ESG quite seriously. I think we have done things. We've actually recorded a few firsts. For example, we are the first company in Indonesia to do an environmental life cycle assessment of our poultry operations, and then recently of our aquaculture operations. Now, what does that mean? It's a science-based approach to actually assessing your production life cycle and to work out your climate impacts across your whole life cycle of actually producing your product. And so we were the first in Indonesia to do that. We're also part of a social life cycle assessment project with the UN, and we are focused on assessing the social impact of our farmer partnership program. And this social LCA hopefully is going, we're in there as a road tester, but hopefully it's actually going to start to set some standards into that are similar to how an environmental life cycle assessment is conducted today. Now, the other leadership role that we've taken in this is also we are the first. We've notched up a few firsts in our sustainability linked bond that we issued quite recently this year. So I would say, how would I put it? If you ask me, I think we take this seriously. Today, or this year, we celebrate, Jason, our 50 years of being in business from the first feed mill that we started.
Right.
And in order to get us to the next 50 years, I think we see sustainability as one of those things that we need to actually be cognizant of, to adjust our operations as best as we can, to understand the impacts of our business. I mean, fortunately for poultry, I would say our impact in terms of greenhouse gases or any other parts of the whole chain is quite minimal. But there are certain parts of our business like beef and dairy which have a higher impact on say, greenhouse gases. So things like that we will work through. But I think as a philosophy, though, it's quite ingrained in us that we look after not only the bottom line, but we also look after all stakeholders, including the community and the environment. So hopefully you get a sense of that in how we actually do business.
Yeah. Kevin, I'm going to put you in the spot here. So investors, I think we look at double materiality in terms of what are the ESG positives and what are the financial positives. So could you give us an example of how an ESG initiative actually brought out a positive financial impact?
Okay, so yeah, I mean, double materiality is an interesting concept, right? Because I guess we've always focused on the material information that has a financial impact. Double materiality is talking about material information with a non-financial impact. And I think climate is definitely up there on the cards. Now, everything that you do for ESG, I guess, is an attached cost. And for the most time, you actually don't see the benefit because the benefit is quite nebulous. You know, it's save the world, save the planet, you know, reduce greenhouse, global warming. That is sometimes hard to measure and hard to actually equate to the financially beneficial to the company versus the cost, which you obviously see hitting your P&L, right? Yeah. So I think that's quite an issue, essentially, I think our journey is that we made sure that we had buy-in from top management, that this was important to the business. Yeah. It was important to the founder that he wanted to see the business last a long time, right? And we should take some of these concerns as part of our community, or give back to the community and give back to the world. So I think you need management buy-in to get that across the board. Now, examples of where that has been beneficial are quite hard to find, but in sustainability, in our sustainability bond, our target, sustainability performance target, was water recycling plants, right? Yeah. So we put the target out there, and we expected it to be a cost, because what we do is we've already got wastewater treatment plants. So the water that treats the waste and wastewater, we treat it already. And what we now are going to put in is plans to recycle that water and reuse it in the operations. Yeah. Now, nobody else has done this. It's not part of government requirements at all to do water recycling. So we've taken that step beyond what is just compliance, and it's way beyond compliance. So the reason for doing that is we felt that we use a lot of water in our operations, and some of the water, if you just give it a little bit of cost in recycling, we can reuse it, right? Now, what we found out after doing some of the research for us to actually implement these projects, we found out in certain water scarcity areas in Indonesia that for 3 to 4 months every year, that operation, like the feed mill or the processing plant, the slaughterhouse, they had to actually buy water, which cost them money. So now that we're putting in water recycling, they can see a payback in 5 years. So, and that's a positive result. So you actually get the operational people going, oh, this is actually good. It's not really a cost, because before that, they was just saying, you're adding a cost per head of chicken for me, right? Versus my competitors who are not doing this water recycling, why are you doing it to them? Yeah. So I think that is a beneficial plus, but it's tough to find examples, Jason. Tough to find examples.
Yeah. I think based on just my 2 cents worth, because I've been reading this topic with interest, I think financiers have been jumping on this sort of, I hesitate to say the word bandwagon, but to some extent it is. But so as the situation matures, I think in terms of, say, cost of capital, access to capital, there might be positive impacts in the future, but let's see. So I think we have a couple of minutes left, and I think let's address a pressing issue, which is valuation. So we have seen a pretty sharp pullback in the share price. And based on traditional metrics, forward PE is 6.6, price to book is 0.7 times. This is significantly lower than peers. And I've actually done a back of the envelope calculation of the sum of the parts. Mm-hmm. So the Japfa's market cap relative to the sum of the TBK, which is listed in Indonesia, and also the implied valuation of Asia based on the latest transaction price. So the implied discount is actually 30%. So how would you respond to this valuation gap issue for Japfa? What are the concerns that investors might have?
Yeah, I mean, obviously the statement I have to make is we believe that we are undervalued, and I guess the reason for that, I would probably put it at a few reasons. Number one is we don't have comparables in Singapore. So there's not much of a farming business in Singapore. I mean, if you go to Australia, farming businesses are well known. Even in Indonesia with our PT Japfa Tbk, our listed subsidiary there, because they had 2 and maybe 3 other listed subsidiaries in the same space within the Indonesian market, I think I've got 20 to 30 analysts that cover PT Japfa Tbk, versus limited, where the coverage is very, very sparse. And, I think our comparables are probably, well, we would imagine like CP out of Thailand. Within the Singapore market, there's not many comparables. That's number one. Number two, I think agribusiness cyclicality just is a worry for people. because the price of chicken, the price of pork goes up and down. You talk about disease, etc., and that causes some cyclicality. So I think when we look at our business, we don't look at our business in 3-month slots as well. We look at our business on a long-term basis, on how the basic business, whether we are one of the most efficient or lowest cost businesses in that country. Right. And all these cycles we should be able to ride through. And what we've done in our information decks since we got listed in Singapore is to try and keep reflecting on that we go through cycles for sure. But, because of our 5 proteins, 5 countries, because of our basic business principles, we should ride through these cycles. And to some extent, we should come out stronger post the cycle. And that has happened in a few instances, like recently we had African swine fever that affected swine. And today it continues to affect swine. But what that has done is actually consolidate the market share among the industrialized producers of swine in Vietnam. And in the long run, that means we will have a stronger position and a stronger market share going forward. And in the long run, that should do really well for the business. So this is minor down and hiccups that affect probably the people that don't put in biosecurity as well as industrialized producers and people that don't know the structured way to farm, So I would imagine that some of this is positive for our business in the long run. So I guess that's my reasoning for why we are undervalued and not appreciated. But hopefully, and probably the other thing is we don't have a lot of products that we sell in Singapore. So we are more well known in the farming communities around Indonesia, around Vietnam, in terms of wholesale and the farming communities, but less so in terms of consumers, which is a Singapore market.
Yeah. All good. It's very normal to have this discourse in terms of how you should value something. So hopefully more people align to your views and your costs. Let's see.
Thank you, Jason.
Anisha, I'm not sure how long we have. There's a couple of loose questions. Should we go through them?
Sure, you can take a couple more if you all are available. Maybe another 5 minutes, maybe we could do. Okay,
I'll literally go from the top. So number 1 is, how do you increase milk yield? Is it helpful?
How do we increase milk yield? So how are we the best yields in China? I love that question. So essentially, I'll use an analogy of if you were building a basketball team. And if I gave Jason the ability to build a basketball team from scratch that was going to compete in the NBA among the top teams in the world, right? Jason would go out there and choose babies that had a genetic potential of 6'5" and above. And then he'd feed them well and train them in basketball. So that's basically what we do in animal protein. So in other words, if I don't start with the right genetics, there's no chance I'm going to be an international basketball player. So no chance I'm going to be the most efficient and lowest cost. So I must use the right genetics. So I align myself to the best genetic companies in the world. And part of why we have the best yields is because when we take the cows from Australia and breed them in China, cows, of course, to produce milk, they need to get pregnant first, right? And when they get pregnant, their offspring, the boys are basically not relevant in the dairy farm, but the girls stay on as they're replenishing the next dairy herd to produce milk. So what we do is we use the best semen out of the US, good genetics, which improves the yields and the structure of the dairy cow. So by using that, we improve the genetics that we get from Australia for each cycle. So as we replenish and grow our dairy farms, we actually use the dairy cattle that is homegrown in our dairy farms, and the genetics just keep getting better and better. On top of that, we make sure that the cow is super happy and comfortable so that nothing stresses the cow. Life is good. And in that way, they they just produce more milk. Happy cow equals more milk. So I think it's attention to detail in the end, and the people that run those farms is a big factor as well.
Yeah. Cool. So there's a question about COVID leading to increase, work from home and distribution going online. So I guess is Japfa seizing the opportunities this presents, or like moving? Yeah.
Yes, we are certainly looking at that. It has affected some of our downstreaming in Indonesia. We are looking at that last mile distribution and cutting out of the middleman to the customer. But that happens in major cities, but we are looking at that. It's a process that we need to go through. I think in Indonesia, we've had that project ongoing for the last 4 or 5 years. In Indonesia and Vietnam, I think that project is well down the track. But it's not in a big way. As I said, today in Indonesia, about 85% of chicken is still distributed through wet markets. So only a small portion actually hits the big cities. But we understand that is the future, and we are building the right infrastructure, but it's a slow process.
Right. Next is, could you share more about the recently announced aquaculture initiative?
Recently announced aquaculture. Okay, so the aquaculture initiative, I don't know which one you're referring to. We've had a joint venture about a year ago with a breeding company to make shrimp fries. It's Kona Bay fries. It's probably producing about 50% of the shrimp fries that go into shrimp farming in Indonesia. So we had a joint venture with a company that does that out of the US. And so we actually have a multiplication center, we call it, in Indonesia now as a joint venture company. So by producing the fries and selling the fries, we actually get the opportunity to sell the feed and the fries as a package. And that's basically how we sell our feed as well in Indonesia for poultry, because we produce the day-old chicks. You have good quality day-old chicks. That means you've got good genetics. The farmers like the quality, the low mortality, the delivery of product, quick time to market, etc. So the farmers buy your day-old chick, and typically they would buy the feed as well. And really, we make our money in feed, because feed is the stable pillar of profitability for us. So we try to sell more feed. So in that way, I think that's how we actually grow both sides of the upstream business.
Just very quickly, I guess the question that follows is the 3 pillars are swine, poultry, and dairy. Will aquaculture ever meet the similar standards or levels?
Not yet. I mean, I think the aspirations is to grow that as the 4th pillar, correct? It will take time, but I think Japfa, given the nature of our business, everything is slightly longer than 3 months. So that's a problem when it comes to investors, that have a 3-month view of life. I mean, when we build a dairy farm, it probably takes about 3 to 4 years to actually get you to fully milking stage. When you're building a breeding operation for chicken, it takes about 2.5 years to go from grandparent, parent down to final stock. When you build a swine breeding, when you start at great grandparent stock level and a breeding, it takes about 5 years before you actually start producing piglets that you can fatten and send to the market to become char siu and siu yolk. So everything takes time in our business. And I would say, that's hopefully you get an understanding of how we actually look at operations.
Right. Maybe one more ESG related question before we close for comments. Final comments from Anisha. So we have a question. I'm not sure if there's an easy way to answer this, but methane for dairy business is obviously an issue. So what are Japfa's what is Japfa's approach to tackle or minimize the methane emissions?
Okay.
Yeah.
So methane comes from cow poo and cow farts, basically, right? Now, when it comes to the waste of cows, we can actually collect that waste because we are an industrialized farm concept, right? So the cows are all in big barns, so we can actually collect the waste and send it down to a biodigester, which is an anaerobic process, which actually releases the methane, which you can burn and produce electricity from that. So that's okay for the waste. But basically, the cows are in open sheds. They walk around, they walk down to the milking parlors, etc.
Yeah.
It's very hard to capture their farts, basically, right? Which also release methane. So the only way I think today that some people are looking at and researching, and we will actually go in that direction ourselves in the future, is to look at how we can change the feed components to reduce the gas that's actually coming out from the cow. So I think that's probably some initiatives that we can do. But in terms of biodigester, most of the operations in China are covered by environmental requirements to have biodigesters in place anyway.
Thanks, Kevin. Anisha, I'll hand it over to you for closing comments.
Well, thank you so much, Jason, for those intriguing questions and teasing out quite a bit of information on Japfa, and Kevin, for you for going through in a fairly comprehensive presentation, sharing about the dairy business, the strategy in China, ESG like initiatives, and how that flows through the company and its operations. So really thankful to the both of you to share all this information today, and for the audience who've been so engaging as well and asked a lot of questions. Thank you all. And with that, I will close today's webinar and see you next time.
All right, thank you.
Thanks. Thank you.